ExamPrep.School. Alaska Reinsurance Intermediary Manager exam code InsAK-RIM91 or OPRIM91. There are 5 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Appointment of a RIM. Operating requirements for RIM qualifications. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Under Alaska Statute AS21.27, which statement correctly distinguishes a reinsurance intermediary manager from a reinsurance intermediary broker? A. A reinsurance intermediary manager negotiates reinsurance contracts on behalf of both insurers and reinsurers, while a broker only coordinates placement without negotiating terms. B. A reinsurance intermediary manager provides program management and administrative services to a ceding insurer's reinsurance portfolio, whereas a broker negotiates terms between insurers and reinsurers for a commission. C. A reinsurance intermediary manager is required to maintain a trust account for premium funds, while a broker is prohibited from holding any premium funds. D. A broker undertakes actuarial analysis for reinsurers, while a manager exclusively handles legal documentation and regulatory filings. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is B. The correct answer is that a reinsurance intermediary manager provides program management and administrative services to a ceding insurer's reinsurance portfolio, whereas a broker's role is to negotiate terms between insurers and reinsurers for a commission, consistent with AS21.27 definitions. Reason A is not correct. This is incorrect because managers do not negotiate on behalf of reinsurers. Negotiation is the broker's primary function. Reason C is not correct. This is incorrect because trust account requirements are not the defining distinction between managers and brokers. Reason D is not correct. This is incorrect because brokers do not focus solely on actuarial analysis, and managers are not limited to legal filings. Question 2. A captive insurer domiciled in Alaska engages a reinsurance management firm to negotiate treaties, collect premiums, and manage claims for its reinsurer operations in the state. Under Alaska Statute 21.27.020, which party is required to hold a reinsurance intermediary manager license? A. The law firm retained to advise on treaty language. B. The independent claims adjuster hired to process reinsurance claims. C. The reinsurance management firm performing treaty negotiations and premium collection. D. The external audit firm conducting compliance reviews of the reinsurer's activities. The correct answer is C. The reinsurance management firm must hold a RIM license because AS 21.27.020 defines licensed managers as those who negotiate treaties, collect premiums, and manage claims for a reinsurer's business in Alaska. Reason A is not correct. Providing legal advice on treaty language does not constitute managing the reinsurer's business, and thus does not require a RIM license. Reason B is not correct. Handling claims processing alone does not amount to managing the reinsurer's business functions requiring a license. Reason D is not correct. Conducting compliance reviews is a consulting function and does not involve managing the reinsurer's business requiring a license. Question 3. Under Alaska Statute AS 21.27.30, which of the following activities requires an individual to hold a reinsurance intermediary manager license rather than being performed by an unlicensed third party? A. Negotiating reinsurance agreements on behalf of a ceding insurer. B. Providing record-keeping services for a ceding insurer's reinsurance contracts. C. Assisting in preparing market analyses of potential reinsurers. D. Drafting internal underwriting guidelines for an insurer's risk retention strategy. The correct answer is A. The correct answer is negotiating reinsurance agreements on behalf of a ceding insurer because AS21.27. 30 requires those who actively negotiate or place reinsurance to hold a RIM license. Reason B is not correct. This is incorrect because providing record-keeping services is an administrative function that does not require a RIM license. Reason C is not correct. This is incorrect because assisting with market analyses is advisory and does not involve placing or negotiating reinsurance. Reason D is not correct. This is incorrect because drafting internal underwriting guidelines is a support activity, not negotiating or placing reinsurance. Question 4. According to AS21.27, 30, a reinsurance intermediary manager is prohibited from which of the following actions? A. Placing reinsurance business with a reinsurer not authorized to transact business in Alaska without obtaining approval. B. Facilitating treaty reinsurance agreements between authorized reinsurers. C. Conducting regulatory compliance audits of its own trust accounts. D. Communicating record requirements to a ceding insurer. The correct answer is A. The correct answer is placing a reinsurance with an unauthorized reinsurer without approval, because AS21.27. 30 prohibits RIMs from placing business with reinsurers not authorized in the state absent prior authorization. Reason B is not correct. This is incorrect because facilitating agreements between authorized reinsurers is permitted under the statute. Reason C is not correct. This is incorrect because conducting compliance audits of trust accounts is within the RIM's oversight responsibilities. Reason D is not correct. This is incorrect because communicating record requirements to a ceding insurer is part of permissible compliance duties. Question 5. Under Alaska Statute 21.27. 30. Which of the following fiduciary duties is explicitly imposed on a reinsurance intermediary manager in relation to a reinsurer? A. Commingling premium funds with operating accounts to facilitate administrative efficiency. B. Maintaining reinsurance premium funds in a segregated trust account exclusively for the benefit of the reinsurer. C. Withholding underwriting risk assessments from the reinsurer, absent explicit consent. D. Automatically renewing fiduciary trust agreements without providing notice to the reinsurer. The correct answer is B. The statute requires that all reinsurance premiums received by a RIM be held in a separate trust account for the reinsurer's benefit, prohibiting commingling with other funds. Reason A is not correct. The statute prohibits commingling premium funds with other accounts and requires separate trust segregation. Reason C is not correct. The statute mandates full disclosure of underwriting information rather than withholding risk assessments. Reason D is not correct. The statute does not authorize automatic renewals without notice. Its focus is on fund segregation. Question 6. After relocating its corporate headquarters, a reinsurance intermediary manager stored original reinsurance contracts on an out-of-state server while keeping only scanned copies in its Alaska office. When the Alaska Division of Insurance requests immediate access to the original contracts, which action best satisfies the record-keeping requirements under AS21.27? 30. A. Provide electronic extracts of the contracts but retain originals out of state. B. Ship the original contracts to Alaska within 10 business days. C. Maintain the original contracts at the Alaska office or on an Alaska-based system accessible for examination. D. Offer scanned copies via secure portal and offer on-site review at the out-of-state server. The correct answer is C. The correct action ensures that original records are maintained in Alaska or on an Alaska-based system, so they are immediately accessible for regulatory examination. Reason A is not correct. providing only electronic extracts while keeping originals out of state, does not meet the requirement to maintain originals in Alaska. Reason B is not correct. Shipping originals within 10 business days delays immediate access, which does not satisfy the requirement for prompt availability. Reason D is not correct. Offering scanned copies and remote review does not fulfill the obligation to keep originals readily examinable in Alaska. Question 7. Under AS 21.27. 100 governing the appointment of a reinsurance intermediary manager, the contract must include an underwriting guidelines and authority limits clause. Which of the following best describes the required contents of this clause? A. Establish acceptable risk categories, maximum line sizes, geographic territories, and cedent approval conditions. B. List commission structures, submission deadlines, treaty durations, and financial reporting intervals. C. Define acceptable loss ratios, premium payment schedules, runoff provisions, and capitalization requirements. D. Detail risk appetite per risk and aggregate retention limits, covered policy types, and procedures for exception notifications. The correct answer is D. This option is correct because the clause must specify the manager's risk appetite, set both per risk and aggregate retention limits, identify which policy types are covered, and define how exceptions must be reported. Reason A is not correct. This option is incorrect because geographic territories are not mandated components of the underwriting guidelines and authority limits clause. Reason B is not correct. This option is incorrect because commission structures and financial reporting are governed by other contract provisions, not the underwriting guidelines clause. Reason C is not correct. This option is incorrect because loss ratios and capitalization requirements fall outside the scope of the underwriting guidelines and authority limits clause. Question 8. An insurer drafts an appointment agreement with its reinsurance intermediary manager that requires the manager to submit transaction reports semi-annually within 60 days of period end. The insurer consults AS 21.27. Dryden to determine the required periodic accounting and transaction reporting obligations to include in the agreement. Which provision must the agreement contain to comply with the statute? A. A quarterly accounting report with itemized reinsurance transactions within 45 days after each quarter end. B. A monthly accounting report within 60 days after each month end. C. An annual accounting statement within 30 days of the insurer's fiscal year end. D. A semi-annual accounting statement within 90 days after each 6-month period end. The correct answer is A. The appointment agreement must obligate the RIM to provide quarterly itemized accounting of all reinsurance transactions and remit any due funds within 45 days of each quarter's end, consistent with AS 21.27. 100 requirements. Reason B is not correct. Monthly reporting within 60 days exceeds the allowable deadline and is more frequent than the quarterly requirement. Reason C is not correct. The statute does not permit annual reporting. It mandates more frequent quarterly accounting. Reason D is not correct. Semi-annual reporting fails to meet the quarterly frequency required by statute. Question 9. Under AS 21.27. 100. Within how many days must a direct writer file a true copy of every contract entered into with a reinsurance intermediary manager with the Alaska director, measured from the later of the contract execution date or the date the appointment becomes effective in a state? A. Within 10 days after the later of contract execution or appointment effective date. B. Within 20 days after the later of contract execution or appointment effective date. C. Within 30 days after the later of contract execution or appointment effective date. D. Within 60 days after the later of contract execution or appointment effective date. The correct answer is C. The correct answer is within 30 days because AS 21.27. 100 requires filing a true copy of each contract with the director no later than 30 days after the later of contract execution or appointment effectiveness. Reason A is not correct. The statute allows significantly more time than 10 days and specifically sets a 30-day period. Reason B is not correct. The requirement under the regulation exceeds 20 days and is set at 30 days rather than 20 days. Reason D is not correct. A 60-day window exceeds the period prescribed by the statute, which is 30 days. Question 10. After terminating its contract to act as the Reinsurance Intermediary Manager, RIM, for Frontier Mutual Re, Northstar RIM must notify both Frontier Mutual Re and the Director of the Division of Insurance. According to AS21.27, 100. What is the required deadline and minimum content of that notice? A. Within 30 days after termination, specifying the effective date and reasons for termination. B. At least 30 days before termination, including the reasons and any proposed successor. C. Within 10 business days after termination, stating only the effective date of termination. D. Within 60 days after termination, outlining reasons and disposition of trust funds. The correct answer is A. The correct answer reflects AS21.27. 100's requirement that following termination, ARIM must provide written notice to both the reinsurer and the director within 30 days, including the effective date and reasons for termination. Reason B is not correct. AS21.27. 100 does not require advance notice or successor information prior to termination. Reason C is not correct. The time frame is too short and omits the required reasons for termination. Reason D is not correct. The 60-day deadline is incorrect and the statute does not mandate trust fund disposition details in the notice. Question 11. Under AS21.27. 50. What is the requirement for a reinsurance intermediary manager regarding the reinsurer's underwriting guidelines? A. Deviate from guidelines if post-transaction approval is obtained. B. Apply alternative guidelines if approved by the insurance commissioner. C. Adhere only to the intermediary's own internal underwriting standards. D. Apply the reinsurer's written underwriting guidelines in all reinsurance transactions. The correct answer is D. The correct answer is that a RIM must apply the reinsurer's written underwriting guidelines in all transactions, as mandated by AS21.27 see FESID 150. Reason A is not correct. Permitting deviations with post-transaction approval is incorrect because the statute does not allow any deviation from the written guidelines. Reason B is not correct. Requiring commissioner approval is incorrect because the statute mandates direct compliance with the reinsurer's written guidelines without special approval. Reason C is not correct. Relying solely on the intermediary's internal standards is incorrect because the RIM must follow the reinsurer's guidelines. Question 12. Which type of documentation must a reinsurance intermediary manager maintain under AS21.27 750 to support risk selection and pricing decisions? A. Only binders for accepted risk without pricing analysis. B. Quarterly summaries of total ceding company premiums without individual risk data. C. Detailed written records of deviations from standard rating manuals with justification. D. Copies of prospective loss ratio estimates without underwriting rationale. The correct answer is C. The correct answer is detailed written records of any deviations from rating manuals, along with justification, as AS21.27. 50D requires documenting risk selection and pricing decisions. Reason A is not correct. Providing only binders without pricing analysis fails to document the rationale and pricing rationale required by the statute. Reason B is not correct. Summaries lacking individual risk data do not fulfill the requirement to document each risk selection and pricing decision. Reason D is not correct. Loss ratio estimates alone lack the underwriting rationale and documentation of decision-making required under AS 21.27. 50. Question 13. A reinsurance intermediary manager has delegated authority to approve treaty cessions up to a 50% share. A broker submits documentation requesting a 65% cession on a high net worth property portfolio. To comply with underwriting controls, what must the manager do before confirming the cession? A. Approve the 65% cession under the existing delegated authority and notify the insurer afterward. B. Decline the cession and instruct the broker to transfer the excess 15% share to another intermediary. C. Approve the cession at the 50% delegation limit and process the remaining 15% through direct negotiation. D. Obtain prior written approval from the insurer's underwriting committee before finalizing the 65% cession. The correct answer is D. The correct answer is to obtain prior written approval from the insurer's underwriting committee because any cession exceeding the delegated 50% threshold must be authorized in writing before confirmation. Reason A is not correct. This approach violates delegation limits by approving above 50% before insurer approval. Reason B is not correct. Outright refusal misapplies controls since negotiation for approval is permitted rather than immediate redirection. Reason C is not correct. Partial approval and manual processing of excess still breaches the requirement for insurer consent on cessions above delegation. Question 14. A catastrophe model update shows that the portfolio's potential loss from coastal hurricane exposures now exceeds the predefined catastrophe tolerance. Under exposure monitoring procedures, what immediate action must the reinsurance intermediary manager take? A. Increase retention thresholds for high-frequency, low-severity risks to offset the catastrophe accumulation. B. Temporarily suspend all cessions in the affected maritime region until risk levels fall below tolerance. C. Submit a detailed catastrophe exposure report to the state regulator within 30 days of the model update. D. Notify relevant ceding insurers and arrange additional retrocession coverage to mitigate the excess exposure. The correct answer is D. The correct action is to notify the ceding insurers and secure additional retrocession to reduce the exposure below the tolerance limit, as immediate mitigation is required under aggregation controls. Reason A is not correct. Adjusting retention for unrelated risks fails to address the specific catastrophe accumulation in the hurricane-exposed segment. Reason B is not correct. Suspending all cessions is overly disruptive and not required when mitigation options such as retrocession exist. Reason C is not correct. Regulatory reporting does not substitute for the immediate risk reduction measures mandated under exposure monitoring procedures. Question 15. Under AS 21.27. 50. How must a licensed reinsurance intermediary manager segregate fiduciary premium funds in a trust account? A. Hold fiduciary funds in a custodial account titled in the insurer's name, managed by the RIM outside of its own trust accounts. B. Maintain separate trust accounts for each insurer and prohibit any aggregation of premium funds across different insurers. C. Deposit fiduciary funds into a general operating account, provided premiums are tracked separately in monthly reconciliations. D. Maintain one or more trust accounts separate from operating funds, aggregated for multiple insurers with a subsidiary ledger for each insurer's premium funds. The correct answer is D. The correct option reflects that a RIM may use one or more premium trust accounts separate from its operating funds and aggregate funds from multiple insurers only if a detailed subsidiary ledger segregates each insurer's premiums, as required under AS 21.27. Fees. Reason A is not correct. Fiduciary funds must be held in the RIM's own trust account, not in an insurer-titled custodial account. Reason B is not correct. Prohibiting any aggregation is incorrect because aggregation with a subsidiary ledger is permitted under the statute. Reason C is not correct. A general operating account is not allowed for fiduciary funds, which must be held in a designated trust account. Question 16. ARI. M receives $200,000 in reinsurance premiums on July 10th and later processes $50,000 in return premiums due to policy cancellations. Under Alaska operating requirements for RIMs, by what deadlines must the manager remit the premiums to the reinsurer and the return premiums? A. Remit within 15 days, return within 30 days. B. Remit within 30 days, return within 60 days. C. Remit within 45 days, return within 90 days. D. Remit within 60 days, return within 30 days. The correct answer is B. Alaska statutes require that all premiums received be forwarded to the reinsurer within 30 days of receipt, and any return premiums processed due to cancellations be remitted within 60 days of processing. Reason A is not correct. The 15-day remittance is shorter than the statutory 30-day requirement and understates the return premium deadline. Reason C is not correct. The 45-day and 90-day timelines exceed the maximum statutory allowances of 30 days for premiums and 60 days for return premiums. Reason D is not correct. This option reverses the required deadlines by applying the longer period to premiums and the shorter to return premiums. Question 17. ARI. M collects $150,000 in reinsurance premiums under a contract that allows a $1,000 trust service fee per statement period and a 6% commission calculated on net premiums after fee deduction. Under these terms, how much must the manager remit to the reinsurer for that period? A. $140,060. B. $140,000. C. $140,940. D. $140,100. The correct answer is A. First, deduct the $1,000 service fee, leaving $149,000 in net premiums. Then calculate 6% commission on that net, $8,940. Subtracting fee and commission from gross premiums yields $140,060. Reason B is not correct. That amount also stems from applying commission on gross premiums and then subtracting the fee, which misorders the deductions. Reason C is not correct. This figure deducts only commission on net premiums but fails to account for the required service fee. Reason D is not correct. This calculation applies commission to gross premiums before fee deduction, resulting in an inflated remittance. Question 18. Under AS21.27. 50. How often and by what deadline must a reinsurance intermediary manager furnish accounting statements to each reinsurer? A. Monthly, no later than 60 days after the end of each calendar month. B. Quarterly, no later than 60 days after the end of each calendar quarter. C. Monthly, no later than 15 days after the end of each calendar month. D. Monthly, no later than 30 days after the end of each calendar month. The correct answer is D. The statute requires RIMs to submit accounting statements on a monthly basis, with each statement furnished within 30 days after the close of the calendar month to ensure timely premium and commission reporting. Reason A is not correct. The allowable window is 30 days, not 60 days, following the end of each calendar month. Reason B is not correct. The statute does not permit quarterly statements as the primary reporting frequency. It specifies monthly submissions. Reason C is not correct. The deadline is not 15 days, but rather 30 days after the calendar month ends. Question 19. ARIM prepares its quarterly production, session, and loss report for reinsurer Alpha Re. According to Alaska regulations, which element must be included in the session summary section of this report? A. Total premiums written by each cedant during the quarter. B. Gross loss payments and outstanding reserves for each ceded risk. C. Percentage of each cedant's business ceded to each reinsurer. D. Full policy wording for all ceded treaties. The correct answer is C. The correct answer is that Alaska regulations require reporting the percentage of each cedant's business ceded to each reinsurer in the session summary. Other elements belong to the production report, the loss report, or are not statistical requirements. Reason A is not correct. This detail is part of the production section, not the session summary. Reason B is not correct. Loss payments and reserves belong in the loss report, not the session summary. Reason D is not correct. Treaty text is not a statistical element required in the session summary. Question 20. During an on-site audit, the Alaska Division of Insurance requests electronic access to a RIM's underwriting database and copies of related loss files. Under AS21.27. 50. Which action must the RIM take to comply with both reinsurer and regulator access rights? A. Grant the regulator immediate read-only database access without notice. B. Provide requested records to reinsurer and regulator within 5 business days and permit inspection. C. Allow regulator only aggregated reports while giving reinsurer full database interrogation. D. Require reinsurer to submit a written request and pay a fee before any record access. The correct answer is B. The correct answer is that the RIM must furnish requested records to both the reinsurer and regulator within the specified timeframe and allow on-site inspection. Limiting regulator access to aggregates or charging the reinsurer fees would violate Alaska regulations. Reason A is not correct. Immediate access without notice conflicts with established procedures for record requests. Reason C is not correct. Regulations grant the regulator full record review, not just aggregated data. Reason D is not correct. Imposing fees on the reinsurer for access is not permitted under the operating requirements. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.